G'day again, investors. Today we'll be talking about strategy on how to choose which shares you want to trade or invest in. So we're going to cover the what type of companies to trade, selecting those companies, collecting the data to compare, building a portfolio, reviewing your results, and time management you need to invest. First off, the type of shares we're going to trade are going to be blue chip shares from your preferred index. And I've just got a couple of Google definitions there of what blue chip means and what a share index means. So a blue chip company is basically a term used to describe the shares of a leading company that is in it's a strong name in the industry whose products or services usually dominate their respective markets. Whereas a share index, where these companies may reside, is a number that indicates the state of a stock market. It's based on the combined share prices of a set of companies. So this slide just shows you from that particular website, the investing.com Indices website for major indices. You can see there's a whole bunch of indices across many countries, including Australia, the US, Brazil, Germany, France, etc. So you can choose companies from any of these indexes and trade those companies. So again, we're trying to pinpoint blue chip shares out of these indexes. Today we're going to talk about the A650 Index from the Australian stock market. And what we've done here is we've sorted the top, and it's showing there the top 15 or so companies on the A650, sorted by market capitalisation. It doesn't necessarily mean the Commonwealth Bank is going to outperform BHP or CSL and so on. It just they're just simply sorted by market capitalisation, and we're going to use that as a baseline to select our blue chip companies. Once you've selected the type of companies from a particular index, then you need to look at the sector those companies reside in. And in this example, those highlighted companies there under financials, for instance, if you want to choose the top one or two banking stocks or financial stocks, you can see there by market capitalisation, Commonwealth Bank is at the top, followed by Westpac Banking Corp, National Australia Bank, and so on. What we're going to aim to do is choose one of those companies out of financials and then choose another company from a different sector. So for example, we may choose Commonwealth Bank out of financials, we may choose Santos for energy, we may choose the Coles Group for consumer staples, and so on. This is just an example website, the New Market Index website, which helps you identify and pull various data points for your analysis as we try to identify which shares you want to choose. Another good source of information is Yahoo Finance, and again, very similar information in terms of your PE ratings, your dividend share yields, etc. Just be mindful as well, these different websites may have slightly different results for the same KPI, but that's usually because of timing and the way they're reported or pulled out of the systems to report those company results. So comparing KPIs, key performance indicators, we're looking at primarily dividend yields for each company. It doesn't necessarily mean the highest dividend yield should be chosen. Typically companies which pay a very high dividend, such as 10% dividend yield, are typically not growth stocks. They don't necessarily reinvest their profits back into the business, but rather they pay their shareholders a dividend. What we're trying to identify are growth companies, and generally they pay a small dividend and they reinvest the other profits back into the business. A good baseline or ballpark number of dividend yield is about 3 to 5%. You can see there are a couple of examples of those financial stocks: National Australia Bank, Westpac Banking, Commonwealth Bank of Australia, etc., and what sort of dividend yield they're currently offering. Other KPIs that you may want to consider in your selection process are trailing PE, total debt to equity ratio, return on equity, and so on. We're not going to talk about these today, but I'm just basically saying you need to look at all aspects of KPIs and determining which ones are better values for your share selection. To build a portfolio, you want to identify ideally the top. In this example, we're looking at 4 or 5 companies we're going to trade, and that allows us to spend about 10 to 15 minutes a day to review our results on a daily basis. So if you can afford to spend half an hour to review your stocks, you may want to choose upwards of 8, 9 or even 10 stocks to trade. But in our example, we're going to choose 4 or 5 stocks and spend about 10-15 minutes every day reviewing the results. You want to diversify your portfolio. And what does that mean? It means choosing a company from different sectors. So you can see here, as an example, if we want to choose 4 stocks, we're going to choose 1 for the financial stock, 1 healthcare, 1 consumer staples, and 1 energy. So going back to what I showed you earlier, we would pick 1 of these financial stocks, we would pick 1 of these energy stocks as an example, 1 of the consumer staples, and maybe a healthcare stock as an example of a slightly diversified portfolio. In other words, you don't want to choose all these banks to trade, because if they all take a dump because there's a financial issue in the market, then you're probably going to see all of them taking a dump in a downward spiral. So you want to diversify. So if the financials drop for whatever reason, then hopefully the energy market or even the healthcare market may still continue on a bit of an uptrend for you to trade. Hence, diversify your portfolio. So what we're looking at is comparing our sample charts, and we're looking at the financial sector in this example. Again, there's no guarantee of a better return based on the financials of the data we choose, but rather we're using probability of financials returning value to the trades we make. And we're comparing buy and hold versus buy-sell strategies. And our strategy is buy and sell, and I'll explain it in the charts coming up. The primary goal is to make capital gains, and the secondary goal is to collect the dividends in cases where the price moves against us and trades are not closed. So what does that mean? In this example, there are 2 charts here, 2 profitability charts. You can see here where these blue bars are. At the start of those bars, that's where you open the trade, you buy, and where it closes is where that bar finishes. So you bought at that price there. It's a bit hard to see, but that's a cross there, and that's where it's sold. So you made a little profit there, and that's where that profitability line shows a profit is increased from there. This chart down here is a solid blue line. What that means is you've bought back here at the same time you entered there in the buy and sell strategy, except we're buying and holding. We're not trading this one. Bottom line, over the 18 months of trading this particular stock, the National Australia Bank, you can see here, although the price chart has moved in a downward and even slightly sideways market, slightly recovering back here, the overall return, trading $2,000 value of shares at each trade, it's made $650, and our baseline is $100,000. So it's made $650 on that exercise. This one has fallen below our $100,000 baseline, so it's losing about $140 odd so far. So rather than buying and holding, we're buying and selling, buying and selling, buying and selling. As well as a buy and sell strategy, we're looking at dividends being received. Now in this case, there would have been a dividend paid to this person holding this stock here, but if you had used the buy and sell strategy, you would not have received a dividend here because you weren't in the trade. You're in a trade there, you're in a trade here as well. Now you notice here there's dividend paid, ex-dividend. Because you're holding that stock at that point, you would have received that dividend in this example. Here you may have missed out on that dividend because you would have sold just before based on our trading strategy. So overall you would have received 1 dividend in this 18-month cycle, but you would have received a buy and sell profit overall compared to this strategy. This is an example where, because the market was in the price chart was in a similar trend to the previous one, although it didn't recover enough, you would have bought the stock back here and you would have accumulated more stock at each of these points. So you can see there, you would have bought the stock here, and then accumulate more here, and it would have paid dividends at that point. You would have received the dividend there, and you would have received a dividend here. And this is for the Westpac Banking Corp company. And again, you can see here we're down about $450 on the buy and hold, although this one closed out recently, and you would have been up about $315 plus whatever dividends were received in these 2 points. So again, we're choosing blue chip stocks which typically pay dividends. We're not trading penny stocks which don't pay dividends or don't have any side benefit if the market goes down. Another example of mostly single trades up here. So again, buying and selling, and you would have received the dividend there. You probably would have missed on that one. Buy, sell, buy, sell, buy, sell, buy, accumulate, and sell, and you would have seen the dividend there. So this one made $770 over the 18 months. This one was made only $180. So it did recover above the $100,000 baseline, but still not as much, not as lucrative as this one. And again, we're trading $2,000 lots for each time we buy these shares. Another example of ANZ banking, very similar scenario: buy, accumulate, and sell. You would have received a dividend there. Buy, accumulate one, and then sell. That was a nice little spike. So you can see there that made $988 overall. This one is still down about $210 roughly. So in summary, we need to choose good stable stocks to trade, that is blue chip companies. We're comparing companies from the same sector. So we're trying to diversify our portfolio from various blue chip sectors. So when you're comparing companies in the same sector, again, you're trying to determine which one is the best statistical probability of performing better than the others within the same sector. Then to diversify your portfolio, you choose, if you're trading 4 companies, for example, you want to choose from 4 different sectors. Limit the number of companies you trade depending on the time you have to invest daily. So if you can't afford to look at this daily, then you have to choose minimal companies to trade, maybe 2 or 3 or even 1. The goal here is to make capital gains, and the secondary goal is to get dividends where the market moves against you. That's it for today. Thanks for listening. Click on the subscribe button or the notification bell, and we'll speak to you next time.